Welcome back, everyone, to the Deep Dive. Looks like you've sent us something pretty interesting this time.
Oh.
The Reserve Bank of India's Financial Stability Report, the December 2024 one.
Ah, yes. Dense, but certainly an important document. Gives a good overview of the health of India's financial system.
I was thinking it's kind of like a financial State of the Union for the entire country. What do you think?
Yeah, that's a good way to put it.
I mean, it covers just about everything. Global trends, how the banks are doing, regulatory changes, the whole 9 yards.
Yeah, it's meant to be pretty comprehensive. It basically tries to figure out just how well India's financial system can handle all the challenges. You know, the ones it's facing both domestically and globally.
Okay, so let's dive right in. Globally, we've got to slow down. We've got geopolitical conflicts, and then there's the elephant in the room, rising public debt.
Right.
The report actually highlights the IMF's projections for global growth, just 3.2% for 2024, and then 3.2% again in 2025. A bit concerning, isn't it?
It's certainly something to keep an eye on. Yeah. I mean, the report even uses a real-world example of how quickly things can change. Remember back in August of 2024, the whole carry trade unwind?
Oh, right. When everyone was borrowing in Japanese yen and then, bam, things went a bit haywire.
Exactly. Showed just how sensitive the markets can be to any shift in sentiment, which, you know, it can be triggered by just about anything. Changes in policy, economic data, you name it.
So global slowdown is a big one. But the report also mentions rising public debt as a potential vulnerability. How worried should we be about that?
It is a valid concern. A lot of governments are dealing with that growing interest burden on their debt. Makes it harder to support economic growth.
Right. Makes sense.
But I will say there are a few bright spots. Globally, the banking sector actually seems to be pretty strong right now.
Okay.
We're seeing GNPA ratios fall, so that's a good thing.
So fewer bad loans.
Fewer bad loans, exactly.
Okay, so that's good news. The banks are doing okay, at least for now.
Yeah.
But what about the stock markets? The report almost makes it seem like things are getting a little too optimistic, especially with all this uncertainty in the world.
Yeah, they do point out some concerns about asset valuations, particularly in equity markets.
So is it that everyone's expecting a soft landing? You know, hoping that inflation comes down without a recession?
Could be. There's definitely a lot of anticipation around lower interest rates, which seems to be fueling some of the market optimism.
But is it justified?
That's the million-dollar question, isn't it?
Yeah.
The report basically urges caution. It suggests that market valuations might be getting a little bit disconnected from the fundamentals.
I see.
There are also some specific concerns about SME IPOs, particularly in India. Seems like there are some instances where the fundamentals in the stock prices just don't match up.
Oh, interesting.
SEBI, India's securities regulator, has even observed some practices that could be artificially inflating those stock prices.
So some potential red flags there, particularly in the mid-cap and small-cap segments. Makes you wonder if some investors are getting caught up in the hype, you know, without fully understanding the risks.
Very true. Really important for investors, especially new investors, to do their homework, understand those risks before jumping in.
Absolutely. Okay, so we've talked about the global picture. Seems a bit mixed. Now let's bring it home to India. Amidst all this global uncertainty, how's the Indian economy performing?
Now, this is where things get interesting.
Yep.
Indian economy has actually shown some incredible resilience. In fact, it's been outperforming other emerging markets. In 2024, the MSCI India Index had a return of 19.5%.
Wow.
Compared to the MSCI Emerging Markets Index, which was only 8.3%.
That is a big difference. So what's behind India's success?
Well, a number of factors, really. Strong GDP growth, falling inflation, and a pretty favorable fiscal situation overall.
Right.
Corporate sector is doing well, too. Steady growth in both sales and profits.
That sounds promising.
Oh, and get this, there's a whole new generation of investors entering the market.
Really? What do you mean?
Almost half of all new trading accounts in India belong to people under 30.
That's amazing. So we've got a new generation of investors, a booming economy. It all sounds pretty fantastic.
Yeah.
But we did talk about those concerns over potential frothiness, especially in those mid-cap and small-cap segments. Does this new wave of young investors play into that at all?
It's definitely something to consider. It's great that young people are engaging with the market, but it's important they understand the risks involved. The report actually mentioned that SEBI had to step in back in October of 2024.
Oh.
They implemented some regulatory actions to stabilize the equity market and try to curb some of that excessive speculation,
I see.
particularly in index derivatives.
So even though the economy seems to be doing well, there are some areas that need to be watched, especially with this new wave of young traders who may not have experienced a major market downturn before.
Yeah. Goes to show the importance of financial literacy. Really important for investors of all ages to understand the risks before making any investment decisions.
For sure. But overall, the report paints a pretty optimistic picture for India, even with all the global uncertainty.
Yeah, for sure.
Okay, so we've covered the global landscape, zoomed in on India, but now let's talk about the foundation of any financial system, the banks. How are they holding up?
Well, the report paints a very positive picture of the Indian banking system.
Good.
They're well capitalized, which means they have enough buffer to absorb potential losses. The CET1 ratio, that measures capital adequacy, it's at a healthy 14%. They're seeing strong earnings, and maybe most importantly, there's been a huge improvement in asset quality.
So no need to worry about bank failures in India.
Well, there are always risks, right?
Yeah.
But the data does suggest that Indian banks are in a much stronger position than they were just a few years ago. For example, the GNPA ratio, which measures bad loans, has fallen to a multi-year low, just 2.6% for scheduled commercial banks.
Okay, that does sound good. But how do we know they can actually withstand a major economic shock?
Good question. The report mentions that the banks have gone through macro stress tests, basically simulations to see how they'd hold up under different adverse conditions. And the results, they have enough capital to weather some pretty severe storms.
That is good to know. So banks are stress tested, they've got the capital. But the report also mentioned something about changes in how banks are getting their funding. Can you unpack that a bit?
You're right. There has been a noticeable shift in the funding dynamics. We're seeing a decrease in CASA deposits.
CASA?
Yeah, the funds held in current and savings accounts, which are usually considered cheaper for banks.
Got it.
To make up for this, banks are increasingly relying on certificates of deposit, or CDs, to raise capital.
So CDs are more expensive for banks than those CASA deposits. Could this impact their profitability?
Yeah, they tend to be a bit pricier. It's definitely something to keep an eye on. It could potentially impact profits, maybe even lead to changes in lending practices.
Something to watch. Now, we've talked about bad loans, we've talked about capital. What about the impact of all these interest rate movements on the bank's investment portfolios?
Ah, yes. The report does delve into the whole world of mark-to-market gains and losses. Basically, paper profits or losses that happen because of interest rate changes. Remember when rates were rising earlier?
Yeah.
Well, that caused some paper losses in the held-to-maturity, or HTM, books of banks.
Held to maturity. What's that?
Basically, investments that banks plan to hold until maturity, even if interest rates are doing their own thing. When rates go up, the value of existing bonds goes down, right? Creates a paper loss for the banks.
So even if they're not selling, they still feel the pinch.
Exactly.
But then what happens when interest rates go down?
Well, as it happens, the yield curve shifted downwards in the first half of fiscal year 2024-25. So those MTM losses, they turned into gains for a lot of banks.
So up and down, like a roller coaster.
Pretty much. But it's important to remember these are unrealized, unless they sell those investments before they mature.
Theoretical.
Well,
Got it. But some banks are still facing some losses, right?
yeah, 9 banks are still carrying those notional losses on their HTM books, something regulators will be watching for sure.
Okay. So overall, things seem positive for the banks, but there are definitely a few things that require a closer look. But we've only talked about banks. What about the rest of the financial landscape? The NBFCs, the cooperatives, all those other players, how are they doing?
Great question. The Indian financial system's a lot more than just banks, and those other players have a huge role to play.
Yeah, and the report definitely goes into detail about them, especially about the NBFCs.
So non-banking financial companies, for those who might not be familiar.
Right. They've seen some pretty steady growth, and overall they seem to be in pretty good shape, financially speaking. Strong capital adequacy ratios sitting at 26.1%.
Okay, that's good.
And robust interest margins. Plus, they've attracted more foreign investment, which helps with retail lending. So are they subjected to the same rigorous stress tests as banks, just to make sure they can handle those tough economic conditions?
Oh, yeah, definitely. And according to the report, they've actually performed well in these tests, showing they can handle those credit and liquidity shocks. They're definitely doing their part to contribute to the stability of the system.
Good to know. What about the urban cooperative banks? How are they holding up?
They're doing well. Seems like their capital adequacy and asset quality are improving.
Positive signs. Okay, so NBFCs, cooperatives, all looking good. Now let's talk about mutual funds. They've become incredibly popular in India. I mean, especially with those systematic investment plans, the SAPs.
Right, the SIPs makes it easy for people to invest regularly, even small amounts.
Exactly.
And yeah, mutual funds have seen massive growth because of it. All those household savings being channeled into the financial markets. Generally a good thing, but...
There's always a but, isn't there?
Well, the report does mention some concerns about the rapid growth in those sectoral and thematic funds specifically.
Ah, right. Back to those potentially frothy valuations, especially in the mid-caps and small caps.
Exactly. And these types of funds, they often have a large chunk of their holdings in those segments, which, could be risky if there's a correction. AMFI, the Association of Mutual Funds in India, they've been running stress tests and liquidity analyses, particularly on these funds.
Yeah.
The results do suggest they can handle some pressure, but it's still something for investors to be aware of.
So high reward, high risk. Classic.
Pretty much. Always important to understand the risks involved with any investment, but especially with funds that focus on specific sectors or themes like that.
Right. Makes sense. Okay, so we've covered the global economy, how India's doing, the banks, these other financial institutions. But what about the people who are basically responsible for keeping this whole system running smoothly and safely? The regulators. What are they doing to, protect us from those financial storms?
Ah, yes. The regulators. The report dives into that whole world of regulation, and it highlights a lot of the proactive steps being taken, both in India and globally.
So not just reacting to crises anymore, but trying to anticipate and prevent them.
Yeah, exactly. More like proactive problem solvers than firefighters.
I like that.
Trying to spot those potential vulnerabilities and address them before they cause chaos. And it's a wide range of things they're looking at. Market integrity, cybersecurity, even climate change-related risks.
Wow. That's a lot. What are some of the things they're doing globally?
Well, IOSCO, for one, the International Organization of Securities Commissions, they're tackling this issue of market outages.
Ah, those technical glitches that can halt trading.
Exactly. They're proposing measures to make those trading venues more resilient to these outages, and also outlining how regulators should respond if trading has to be stopped. All about minimizing disruptions and maintaining that investor confidence.
Important, yeah. Especially in today's world, one problem in one market can have a ripple effect. Anything else IOSCO is focusing on?
Leveraged loans and collateralized loan obligations. Those are complex instruments, can amplify risk if they're not managed properly. So they've released a report outlining best practices.
Best practices for what exactly?
Everything. Origination, refinancing, transparency, investor protection, basically trying to shine a light on these instruments and make sure they're not being misused.
Makes sense. So they're adding a layer of protection for everyone, investors and the system as a whole. Now, what about AI? All these new technologies. Are regulators worried about that?
Absolutely. AI is changing the game. The regulators are trying to figure out how to embrace its potential while minimizing the risks.
Right. Walking that tightrope.
The European Commission, for example, they already implemented their Artificial Intelligence Act. It basically categorizes AI systems based on their risk level and then sets requirements for those high-risk applications.
Sure.
And globally, organizations like the OECD and the FSB are discussing how to regulate AI's use in finance.
So a lot of discussion and thought going into that. But what about the risks that are already here? Cybersecurity threats, for example. Feels like every other day there's a new data breach.
Yeah, cybersecurity is a major concern, for sure. Globally, regulators are focused on strengthening those cyber defenses, improving information sharing, and coordinating responses to attacks. It's a constant battle.
Definitely. Now, what about crypto? Big topic these days. Are regulators starting to figure out how to deal with that whole world?
Well, the FSB, the Financial Stability Board, they're leading the charge on that one. They've developed a roadmap for implementing crypto asset regulation, and their latest report shows that most countries are either developing or have already put in place some regulatory framework.
For both crypto assets and stablecoins.
Yep, both. They're definitely trying to get ahead of the curve on this one, establish those clear rules.
Smart. So, crypto's on their radar.
Yeah.
But it's not the only emerging risk, right? What about climate change?
That's another big one. It's becoming increasingly clear that climate change poses some pretty serious risks to the financial system.
How so?
Well, think about it. Extreme weather events. They disrupt business operations, damage infrastructure, lead to insurance losses. And then there's the transition to a low-carbon economy. Some industries might decline, others will emerge, creates financial risks on both sides.
So climate change is a financial issue too, not just an environmental one.
Exactly. And regulators are starting to wake up to this. The NGFS, the Network for Greening the Financial System, is this group of central banks and supervisors specifically focused on these risks.
What are they doing?
Developing guidelines and best practices for assessing and managing these climate-related risks. Designing climate scenarios, even looking at how climate change could affect monetary policy. Big stuff.
Wow. So globally, regulators definitely have their hands full. But what about here in India? What are our regulators doing to protect the financial system?
Well, Indian regulators have also been quite proactive. The RBI, SEBI, and other authorities have implemented a number of measures to improve resilience, prevent fraud, and protect consumers.
That's good to hear.
Let's start with the RBI, the Reserve Bank of India. They've issued revised directions on fraud risk management, provides a framework for all those regulated entities for preventing, detecting, and reporting fraud.
So important these days with all the scams.
Yeah. And they've also introduced a revised prompt corrective action framework, the PCA framework, for those urban cooperative banks. Basically sets specific triggers based on capital adequacy, asset quality, and profitability.
So if a bank falls below certain levels.
Exactly. They face restrictions and have to take steps to fix the problem. Kind of a safety net.
I see. What about those who just, refuse to pay back their loans? What are the measures for those folks?
Oh, yeah, the willful defaulters. The RBI has new guidelines on how to deal with them, provides a clear way to classify borrowers, and outlines the consequences, like restrictions on getting more credit.
So sending a message. You can't just borrow and not pay back.
Exactly. Maintain the integrity of the system. And then there's cybersecurity, which is a huge concern with the growth of digital payments.
Oh, yeah, for sure.
RBI has issued directions on cyber resilience and security controls, specifically for non-bank payment system operators.
So those companies that aren't traditional banks but handle payments?
Exactly. The guidelines cover everything: governance, information security, specific controls for mobile and card payments, really trying to make sure those systems are robust and secure.
Protecting consumers from fraud.
Exactly. And they're also promoting sustainable investments. They've introduced a scheme for trading sovereign green bonds.
Green bonds.
Yeah, in the International Financial Services Center, the IFSC, allows foreign investors to participate in that market. Easier to raise funds for environmentally friendly projects.
Wow, that's a really positive step. Shows India's commitment to sustainability. So RBI's got a lot going on. But what about SEBI, the Securities and Exchange Board of India? What are they doing on the regulatory front for the securities market?
SEBI has also been busy, implementing a lot of measures to protect investors, improve market integrity, and increase transparency. One big change is the increase in the minimum amount you need in your trading account to trade futures and options.
So you need more to participate.
Yeah, higher bar to entry.
Makes sense. So they're basically saying if you want to play with the big kids, you got to have some skin in the game.
Exactly. Got to make sure those investors understand what they're getting into and that they can handle the potential losses. They've also tightened up the rules around intraday trading.
Intraday?
Yeah, when you buy and sell within the same trading day.
Oh, right. Day trading.
The new rules aim to curb excessive speculation, reduce the risk of large-scale defaults.
So trying to protect investors from themselves? A little bit.
You could say that. Making sure people aren't biting off more than they can chew.
Smart. What about market manipulation? Any new rules to prevent that?
Oh, yeah. SEBI is cracking down on unregistered investment advisors. Now it's illegal to offer investment advice or recommendations unless you're registered with SEBI.
Seems like a pretty logical step. Protect investors from those unqualified or, unscrupulous advisors. What else is SEBI doing to protect investors?
They're tightening the rules around IPOs. Initial public offerings.
Right.
Trying to make sure everything's fair for everyone. Stricter disclosure requirements for companies going public. And changes to how those shares are allocated. Prevents certain investors from getting an unfair advantage.
Also leveling the playing field.
Exactly. Helps build trust in the market.
Now, what about those index derivatives? We talked earlier about SEBI taking action to kind of stabilize things.
Right. They've implemented a few things specifically for those. Increase the minimum contract size so you need more capital to trade. Revise the eligibility criteria for stocks, too. Only those with enough liquidity and market depth can be traded as derivatives.
It's raising the bar.
Basically.
Makes it harder for people to gamble with these risky instruments. Okay, makes sense. But it's not just SEBI and the RBI that are making changes, right?
Yeah.
What about those other developments? You mentioned deposit insurance and the corporate insolvency resolution process.
Ah, good catch. You're right. Those are important too. So, deposit insurance. Remember how only deposits up to 1 lakh were insured before?
Yeah, I remember.
Well, now that limit is 5 lakhs per depositor per bank.
That's a big jump. So much more peace of mind for people knowing their savings are safer.
Absolutely. A major step in strengthening that safety net. And then the insolvency resolution process. It's been streamlined, made more efficient.
For companies that are struggling, basically.
Exactly. The government has made a lot of changes to the insolvency and bankruptcy code, trying to make sure creditors get the most value from those assets and that the whole resolution process is fair and transparent.
So less painful and more effective for everyone involved.
That's the goal. It's really impressive how much work is being done to maintain stability in India's financial system.
It is. This report really highlights just how complex and interconnected it all is. I like to think of it as a giant machine. Lots of moving parts.
It is, definitely. So after all this, what are the key takeaways? What should our listeners remember?
Good question.
Well, despite the global uncertainties, some potential risks here and there, the Indian financial system is pretty strong. Resilient, banks are well capitalized, asset quality has improved, NBFC sector is still a major driver of credit growth, and of course, regulators are doing their part to address emerging risks and strengthen the system as a whole.
Sounds like an encouraging outlook.
Yeah.
But what does this actually mean for our listener? What can they do with this information?
This report is a great resource. For anyone who wants to understand how things work and make smart decisions, it's like a map for the financial world.
A map to help you navigate.
Exactly. The report's pretty optimistic, but it's still crucial for everyone to stay informed about the risks and how things are changing, whether you're an investor or just someone participating in the system.
So don't just rely on headlines. Do your own research. Make your own judgments.
That's right.
Well, we've given our listeners a lot to think about today. Any final thoughts before we wrap up?
Just remember, India's financial system is constantly evolving. Things look good now, but stability is an ongoing process. The regulators are doing a great job, but we all have a role to play. We have to stay informed, be careful about the risks, and make good choices.
Words of wisdom. Thanks for joining us for this deep dive into the world of Indian finance. Be sure to check out the full report if you want to learn even more. And until next time, stay curious.